Hey everyone, I'm Tim and welcome back to the channel. The best time to start was yesterday and the second best time is today. I know it sounds lame starting this video with a quote, but it's true. The best time to start investing was in the past, and that's because when it comes to investing, the number one biggest factor in determining your ending wealth is time. Often time makes your regular contributions irrelevant, and I'll link to a video where I explain this in a bit more detail. But what about right now? Because this last year has been weird to say the least. The market crashed, then rebounded almost as quickly as it went down, and the US government seems insistent on pumping the economy with as much money as they can. So a lot of investors are hesitant to put money into the stock market, which may seem fair enough, but I'm here to tell you that that doesn't matter. It doesn't matter if you start investing in the middle of a bull run, at the start of a bear market, or even at the start of the largest recession in living memory, and that's because it will all even out over time. Yes, of course, if you knew what the market was going to do tomorrow and the next day, it would be easy to invest because you just invest depending on whether it's going to go up or down. But since no one knows what the market's going to do tomorrow, the best thing you can do is put time on your side and start investing now. The S&P 500 index, which is what we'll use in our example, is always going to go up or down, but if you're so scared about investing in the middle of a recession while the markets are going down, then you'll also miss the massive upside that comes straight after a recession. Waiting for the right time to invest also creates this false idea that investing is all about short-term gains, which, by the way, it absolutely is not. It's about long-term 40, 50-year gains. So sure, the US government has probably pumped way too much fiscal stimulus into the market, and that may have an effect on the economy, or it may not. But who knows when that effect will happen? It might be tomorrow, it might be 5 years down the track. And if you've held off investing for 5 years because you were waiting for the next crash, you may have missed out on a lot of gains. Imagine if you had have done that before the GFC. Let's say in 2003, which is 5 years before the GFC, you decide there's a massive problem with the subprime mortgage lending sector that you believe is big enough to cause a market crash or even a global recession. But the problem is you don't know how soon, so you pull out of all your stock positions and wait until the storm has passed. Years go by and nothing happens, and then boom, in 2008 the global financial crisis hits and the stock market plummets by 38%. And you feel on top of the world because you've saved a heap of money. Well, you think so anyway. Let's have a look at this spreadsheet that I've made that actually goes through that exact example. Okay, so over here on this side we have the smart investor who was able to predict the upcoming global financial crisis, and on this side we have the passive investor. They don't care what happens, they're just letting their money ride the ups and downs. So our smart investor in 2003 has pulled out of the stock market. So for the first few years they're going to have absolutely no gain right up until 2008. They have nothing because their money is out of the stock market sitting in the bank. And in 2008 the crash happens, the market goes down by 38.49%, and you miss all that, which is great. Now, because you are slightly risk adverse, it takes a while for you to get back into the market, so you don't catch all of the upside that happens in 2009, this 23.45% that happened in 2009, but you do catch some of them. So your wealth goes up by about half of that, and then you catch all of the gains in the following years, leading to a nice ending wealth of $1,850 for a total return of 85% annualized to 5.79%, which is low, but isn't too bad considering there was a big recession in the middle, in fact the largest in living memory. So 5.79% isn't too bad with all things considered. What about the passive investor? They're just going to leave their money in the stock market the entire time, and we can see right up until 2008 they're making big gains, and then the drop happens in 2008, and it does drop a long way from $1,600 right down to $1,026. But because we don't touch our money at all through this drop, we're able to catch the upside from 2009, this 23.45%, and our portfolio bounces back nicely, ending at $2,100 for a total return of 110% annualized to 6.98%. So there you go. Despite the fact there was the largest single year dip since 1937 right in the middle of our timeline, we still managed to make a decent gain. With all things considered, 6.98% isn't too bad at all, and it's a whole percentage point better than this guy over here sitting on 5.79 for the whole 11 years. There's another really important thing to consider as well, and that is not to sell in a recession. Selling in a recession is like buying a brand new iPhone, leaving it unboxed for 5 or 6 months, and then selling it at half the price later down the track. It doesn't make any sense, and to make it even worse, stocks usually rebound straight after a recession. As we can see here, in 2008, the stock market went well down, but then in the same year, it rebounded quite a bit. So if you had have sold around here, you would have missed that drop, but then you would have also probably missed all that gain because you wouldn't have got back in straight away. I guess what I'm trying to say with this video is stop waiting for the market. It's always going to go up and down. That's just how it works. You'll never know when it's going to go up and down next. So get into the markets now. Don't sell when a recession happens and you'll be fine. Yes, you may get a raw deal if a recession happens the day after you start investing, but after 40 or 50 years, you're not going to notice any difference. Just remember, investing, it's not about short-term gains. Thank you so much for watching. If you like this type of content, please do consider subscribing. I post finance-related videos like this one every week. So I'll see you back here next time.